Conservation easements and qualified opportunity zone tax credits sound like the kind of thing your accountant whispers to you, like a secret handshake at a country club. So naturally, we should ask out loud, are they actually too good to be true? Or are they just good enough to be dangerous in the wrong hands? Because the IRS has entered the chat, and they brought subpoenas. Let's back up and talk about what a conservation easement actually is. Because the name alone sounds like something a park ranger invented over a campfire. At its core, you're donating the development rights of a piece of land to a nonprofit. And in exchange, the IRS lets you take a massive charitable deduction, sometimes worth 2, 3, even 4 times what you paid for the land. Now here's where the story gets spicy. Because somewhere between protecting the American wilderness and slashing your 7-figure tax bill, a cottage industry of promoters figured out how to weaponize this thing. They'd buy cheap land, get an inflated appraisal from a friendly appraiser, bundle investors into a syndicated deal, and boom, everyone walks away, paying almost nothing in taxes, while a patch of Georgia's swampland gets a conservation halo. The IRS wasn't exactly asleep at the wheel. They labeled syndicated conservation easements a listed transaction back in 2016, which is essentially the government's way of saying, we see you and we're coming. By 2023, the agency had identified billions, yes, with a B, in what it considered abusive deductions tied to these deals, launching thousands of audits and collecting major settlements from promoters and investors alike. The Qualified Opportunity Zone Credit, or QOZ, came out of the Tax Cuts and Jobs Act of 2017. And on paper, it's genuinely elegant. Defer your capital gains, invest in distressed communities, hold long enough, and watch a chunk of that tax liability shrink or disappear entirely. It was the government essentially saying, we'll let you keep more of your money if you're willing to bet it on places other people gave up on. But here's the behavioral economics twist that nobody puts in the brochure. The people who needed the most discipline to use these vehicles correctly were often the same people most seduced by the headline numbers. A 60% reduction in capital gains tax sounds like a golden ticket, but it comes with 10-year hold requirements, restricted asset classes, and a compliance structure that would make a tax attorney's eyes water. So the gap between the promise and the reality is where most investors quietly drowned. The irony is almost Shakespearean tools designed to incentivize socially beneficial behavior became magnets for the exact kind of opportunistic, short-term thinking they were meant to redirect. Think of it like installing a speed bump to slow traffic and watching someone build a ramp. History rhymes here too, because we saw the same playbook with tax shelters in the 1980s, with limited partnerships in the 1990s, and with carried interest debates that still rage today. Every generation gets its own version of this loophole is definitely fine. Let's address the misconception directly, because not all easements are scams and not all OZ funds are traps. Legitimate conservation easements protecting family, farmland, coastal wetlands, or historically significant properties have genuinely preserved millions of acres and provided real, defensible tax benefits to landowners who follow the rules. The problem was never the tool, it was the toolbox full of bad actors who figured out how to replicate the aesthetics of legitimacy without any of the substance. So what does a rational, disciplined investor actually do with this information? You treat these strategies like a scalpel, not a sledgehammer. They require a qualified tax attorney, an independent appraiser with zero relationship to the promoter, and a sincere underlying business or conservation rationale that could survive IRS scrutiny on its worst day. If someone is selling you a tax deduction like it's a timeshare presentation in Orlando, that's your exit cue. The historical lesson embedded in every tax strategy cycle is the same one investors keep refusing to learn. The return of capital preservation almost always beats the return of tax optimization. Paying a fair tax on a great investment is infinitely better than going to war with the IRS over a questionable deduction that unravels 5 years later with penalties and interest attached like barnacles. Position sizing matters here too, because even if a strategy is technically legal and defensible, you never want any single tax play to be the load-bearing wall of your financial architecture. Think of it like putting all your chips on one hand in poker. Even if you're right, the variance will eventually eat you alive, and the IRS plays a very long game. There's a certain philosophical humility that comes from watching smart, wealthy people get absolutely torched by strategies they were convinced were bulletproof. And it should make all of us a little more comfortable with the word boring. A consistent, well-structured tax strategy using standard deductions, depreciation, cost segregation, and qualified retirement contributions will almost always outlast the flashy syndicated deal that promised to make the IRS cry. If you're sitting on significant capital gains or land with development rights, the conversation isn't should I do this, but have I built a team disciplined enough to tell me no when no is the right answer? The investors who survived the IRS's conservation easement crackdown were almost entirely the ones who had independent counsel, clean appraisals, and a legitimate non-tax reason for the transaction, which conveniently is just called doing it right. We're living in an era where complexity is often sold as sophistication, and sophistication is often mistaken for safety. But the truth is that the most successful real estate and tax investors we've ever studied share one trait above all others. They were comfortable being boring, patient, and consistent when everyone around them was chasing the next big deduction. Discipline, sizing, and consistency aren't just investing principles. They're the closest thing to a cheat code that the financial world actually permits. Whether conservation easements or opportunity zones belong in your strategy depends entirely on your situation, your team, and your willingness to hold the line when a promoter is turning up the pressure, and we're here to help you build that foundation. So check out our links in the description below to get started with real estate investing, home contracting work, and finding the right lenders for your next move.